On September 28, 2022, the Bank of England faced margin calls from UK pension funds exceeding £70 billion. The traders weren't panicking about tax cuts, they were panicking about whether Europe would have enough gas to keep the lights on. And that panic revealed something the textbooks got wrong.
Welcome. You're now entering the incentive layer.
Chapter 1. Why people believed in endless printing. In March 2020, I was sitting on my couch refreshing my phone when the US Senate passed a $2 trillion stimulus bill. I remember stopping mid-scroll. $2 trillion. Where did they get the money? The answer kept coming back. They didn't need to get it. They just typed numbers into accounts. I thought modern monetary theory was just an academic excuse for printing money. That's what the headline said. Deficits don't matter. Spend first, worry later. I almost dismissed the whole thing. But then I read Stephanie Kelton's book, The Deficit Myth, and I realized I was looking at the wrong argument entirely. MMT isn't about reckless spending. It's about a technical fact. If you issue your own currency, you don't need to collect taxes before you spend. You spend first, then tax. The constraint isn't money. It's real resources, workers' materials, energy. For a while, that sounded almost obvious. Of course, the US government can't run out of dollars. It makes them. But then I looked at Sri Lanka in 2022. They had their own currency, they could print rupees all day. And it didn't matter because their foreign reserves had collapsed from $7.6 billion to 50 million, and they couldn't buy fuel to keep the hospitals running. The rupees were infinite, the diesel was not. That's when I stopped believing the simple version. MMT says the limit on spending is inflation, but inflation is just the symptom. The underlying disease is a mismatch between the money the government creates and the physical stuff that money is supposed to buy. And here's where it gets uncomfortable. MMT assumes that when the government spends, the real resources are actually available to buy. It assumes that if you have idle workers and idle factories, government spending will mobilize them. It assumes the real resources are either domestic or easily imported. But what happens when the energy that powers those factories comes from a pipeline that just got weaponized? What happens when the rare earth minerals for your green transition are controlled by a country you're trying to sanction? I told you the constraint was inflation. Actually, inflation was just the thermometer. The real constraint is whether the physical inputs of your economy can actually reach you when you need them. Let me say that again because it sounds insane. A theory about sovereign money forgot to check who owns the oil. But this is only what it looks like at first. The real problem starts when you realize that energy supply chains aren't just expensive now. They're fragmenting into pieces that don't talk to each other. So if Sri Lanka was the warning, why did one of the world's most sophisticated financial markets almost collapse 6 months later? Chapter 2. What happens when resources are broad? In June 2022, an auto rickshaw driver in Colombo waited in a fuel queue for 48 hours. He didn't care about macroeconomic theory. He cared that the central bank had dollars left to buy diesel. They didn't. The pumps were dry, schools closed. Hospitals ran generators until the fuel ran out. I thought Sri Lanka collapsed because they borrowed too much in foreign currency. That's the standard story. Too much debt, too many Chinese projects, corrupt politicians. And sure, those things happened, but then I found a report from the Atlantic Council that said something different. Sri Lanka's crisis wasn't just about debt. It was about demand destruction. The country couldn't afford energy at global prices, so the energy simply stopped arriving. The debt was the symptom. The physical inability to import fuel was the disease. Sri Lanka runs on imported energy. When global prices spiked after Russia invaded Ukraine, their central bank burned through reserves trying to keep the currency stable. They went from $7.6 billion in reserves to 50 million in about 2 years. You can print all the rupees you want. You cannot print LNG tankers. And Sri Lanka wasn't alone. In Japan, the yen depreciated 32% against the dollar after the Bank of Japan kept rates low while the Federal Reserve hiked. Why did the yen collapse? Because Japan imports almost all its energy. After the Fukushima disaster shut down the nuclear plants, the country became dependent on imported fossil fuels. When energy prices rose and the yen fell, every barrel of oil cost more yen than ever before. The Bank of Japan could control interest rates. It could not control the Strait of Hormuz. The irony still catches me. Japan is the country MMT economists hold up as proof of concept. Decades of deficits, debt over 200% of GDP, and no inflation, until energy prices broke the model. Now Japanese consumers face food inflation driven by import costs, and the Bank of Japan is slowly, quietly letting yields rise. In Germany, BASF, the world's largest chemical company, faced an additional 3.2 billion euros in energy costs in 2022. 84% of that hit Europe. CEO Martin Bruder-Müller warned that if gas supplies had fallen below 50%, they would have had to idle the entire Ludwigshafen site. They closed ammonia plants, they cut 2,600 jobs. Germany had euros, Germany had a central bank. What Germany didn't have was cheap Russian gas anymore, and there was no amount of monetary policy that could print a molecule of methane. Bruder-Müller said something that stuck with me. He said Europe's competitiveness is suffering from high costs for most production input factors. He didn't say money, he said input factors. Gas, electricity. The stuff you dig up or pipe in, BASF isn't moving production to Asia because they like the weather. They're moving because in a decoupled world, the location of your energy matters more than the denomination of your debt. I went from thinking this was a developing world problem to realizing it was a physics problem. If you import the energy that makes your economy run, your sovereign currency is only as strong as your ability to buy someone else's fuel. But here's the thing. These weren't poor countries with bad governance. These were advanced economies with sophisticated central banks, and they all hit the same wall. I told you the problem was energy prices. Actually, energy prices were the symptom. The real problem is that the supply chains themselves are decoupling. The gas, the minerals, the shipping lanes, they're being pulled into competing blocks. And when that happens, having your own currency stops being a superpower. It becomes a placebo. That number doesn't care about your monetary theory. If Germany and Japan could feel the squeeze, what happens when the financial system itself is built on assumptions that no longer hold? Chapter 3. Why UK pension funds almost collapsed. At 9:47 a.m. on September 23, 2022, a pension fund manager in London stared at his screen and realized he needed to find billions of pounds before the market opened, not by the end of the week. By 9:48. I thought the UK gilt crisis was about Liz Truss's tax cuts. That was the headline. £45 billion of unfunded tax cuts. The markets revolted. The pound crashed to a record low of $1.03. And yes, that happened. But I was looking at the wrong thing. It took me 3 days to see the pattern. The people panicking weren't calling about tax policy. They were calling because gilt yields had jumped 130 basis points in 3 days, and pension funds using liability-driven investments were facing margin calls the Bank of England later estimated at over £70 billion. Here's how it actually worked. If this sounds confusing, here's how it really worked. UK pension funds had promised to pay retirees fixed amounts decades in the future. To make sure they could cover those promises, they bought government bonds. But bonds weren't paying enough, so the funds borrowed money to buy more bonds than they actually owned. The industry calls this LDI. The pension manager just called it hedging. When gilt prices crashed, their lenders demanded more collateral. The funds had to sell gilts to raise cash, which pushed prices down further, which triggered more margin calls. A doom loop. The Bank of England had to intervene with emergency purchases of £19.3 billion in gilts just to stop the spiral. They bought long-dated bonds and inflation-linked gilts, creating a backstop so the funds didn't all go to zero at once. Andrew Hauser, who was then running markets at the Bank of England, later explained that they had to act because LDI funds were heading toward negative net asset value. If the lenders seized the collateral and sold it, the gilt market would have kept falling. It wasn't a small problem. The bank bought £19.3 billion in gilts, but the total sales by pension funds and LDI funds over that period hit £37 billion. They were fire-selling the safest asset in Britain. But why did gilt yields spike? Because inflation was running near 9%, driven largely by energy prices. The bank's own monetary policy report from May 2022 shows exactly what happened. They noted that global inflationary pressures intensified sharply after Russia's invasion, leading to a material deterioration in the outlook for UK growth. Energy prices were the biggest driver of CPI inflation, accounting for almost half the overshoot above target. This wasn't a mystery, it was a pipeline. So why has it not failed yet? Because the Bank of England could still print pounds to buy gilts. But here's the most surprising part. They weren't buying gilts to help the government spend. They were buying gilts because the financial system had become so leveraged that a physical energy shock almost broke the entire market. I told you MMT's weakness was that you can't print physical resources. Actually, it's worse than that. Even the financial instruments we use to manage money become unstable when physical supply chains fragment. Because the inflation, those fragments forces central banks to hike rates, and the leverage in the system can't handle the volatility. The system was designed to prevent exactly this, and it caused it instead. If the UK almost broke because of gas prices, what happens when countries start actively weaponizing the stuff we need to build everything? Chapter 4. Is this inflation or a change in money? In March 2022, Zoltan Pozsar sat in his office at Credit Suisse and wrote a note that made the rounds on Wall Street. He called it Bretton Woods 3. He wasn't talking about currencies. He was talking about copper, oil, wheat, the stuff you can't print. I thought this was just another inflation cycle. Supply shock, demand shock, central bank hikes. Eventually it cools down. That's the pattern we've seen for 40 years. But then I looked at what was actually happening to global trade. In 2023, China restricted exports of gallium and germanium, critical minerals for semiconductors. Russia redirected its oil eastward through a shadow fleet of aging tankers, bypassing Western insurance and shipping rules. The BRICS expanded to include Saudi Arabia and the UAE. These aren't temporary disruptions. They're structural decoupling. Pozsar made a distinction that changed how I see this. Inside money is claims on institutions, treasury bonds, bank deposits, central bank reserves. Outside money is commodities, gold, oil, things with value independent of any government's promise. For decades, countries held inside money dollars and treasuries as reserves. But when the West froze Russian foreign exchange reserves in 2022, every central banker in the world quietly asked the same question: what if our inside money can be confiscated? The answer is outside money, commodities. And when countries start hoarding commodities instead of treasuries, the entire MMT framework wobbles. Because MMT assumes that a sovereign currency issuer can always mobilize domestic real resources through taxation and spending. It does not account for a world where those real resources are trapped behind geopolitical walls, where lithium is a weapon, where shipping lanes are bargaining chips. Pozsar predicted a new paradigm where commodity-based currencies in the East weaken the euro-dollar system. He wrote that commodities are collateral and collateral is money. Think about what that means. If a country needs oil to back its trade and the oil is priced in a currency you don't control, your monetary sovereignty is theoretical. You can issue all the currency you want. The seller might just say no thanks. The Sofan Center reported in 2025 that states are now investing massive subsidies to build parallel supply chains. The US CHIPS Act authorized $52 billion for semiconductor manufacturing. The EU passed the Critical Raw Materials Act. These aren't efficiency moves. They're bunker-building moves, and every bunker raises the cost of everything inside it. But this is only what it looks like at first. The most surprising part comes next. I told you the problem was that MMT ignores physical constraints. Actually, MMT's deeper flaw is that it assumes infinite substitutability. It assumes that if you can't get gas from Russia, you can get it from Qatar, or build renewables, or restructure demand. But in a decoupled world, there is no substitute for a supply chain that no longer exists. The grid isn't just expensive, it's fragmented. Collateral is money, and this crisis is about the rising allure of outside money over inside money. That's not me saying that. That's Pozsar in March 2022. So if the old theory doesn't fit the new world, what are we supposed to watch for? Chapter 5. What happens next? Last week, I was looking at a chart of Argentina's foreign reserves. In April 2025, they negotiated another $20 billion IMF program because they still can't generate enough dollars to cover their energy imports and debt payments. President Milei slashed spending, cut subsidies, stabilized the peso, and yet the dollar shortage keeps coming back. Because Vaca Muerta might have shale gas, but getting it out requires pipelines, turbines, and foreign capital that doesn't trust your currency. It's hard to know exactly when the next break happens, but here's what we know so far. The countries that are surviving are the ones that either produce their own energy or have rock-solid access to someone else's. The countries that are struggling have sovereign currencies and empty fuel tanks. Here's what I've learned tracking this. The next financial crises won't look like 2008. They won't start with subprime mortgages or tech valuations. They'll start with a country that has plenty of its own currency but can't secure the physical inputs to keep its grid running. They'll start with a pension fund that was technically hedged but got blown up by an energy shock in a market it didn't understand. They'll start with a central bank that discovers its sovereign money can't buy what its economy needs. Does this affect you? If you live in a country that imports energy, yes. If you have a pension, yes. If you own bonds that depend on stable inflation expectations, yes. Can you escape it? Not entirely, but you can understand it. And in a system this fragile, understanding is the only edge. The lesson isn't that MMT is wrong about everything. It's that MMT is a local theory in a global world. It works until the moment you need to import something another country doesn't want to sell you, or until the energy that powers your factories gets rerouted by a geopolitical bloc. If you want to stay ahead of this, don't watch the money supply. Watch the fuel supply, watch the strategic petroleum reserve releases, watch China's gallium export quotas, watch Germany's industrial production numbers. When BASF moves production to Asia because European energy is uncompetitive, that's not a business story, it's a monetary story. It's the physical world voting on the value of your currency. The story is ongoing. I'm still tracking Argentina's reserves, still watching if Japan's trade balance flips back to surplus, still waiting to see if the UK's LDI funds have actually fixed their leverage or just patched it. I'll keep updating as it evolves. Chapter 6. The Central Tension. But here's the central tension that keeps me up at night. We built a financial system that assumes money is the only constraint. We are entering a world where the constraint is physical, fragmented, and increasingly weaponized, and the gap between those two realities is where the next collapse lives. What system or supply chain are you watching that most people are ignoring? Drop it in the comments. I read every single one. And if you want to keep tracking these systems as they face these irreversible pressures, hit subscribe so you don't miss the next one.